are you thinking are looking good going forward?
Well, I'm putting most of my money in cash, and one of the clients of my research firm was a sophisticated high net worth individual has decided to put $1 billion of his own financial net worth last month, all 100% into cash. I would say right now it's better to be safe rather than sorry. We don't know whether this volatility is temporary and things are going to improve, or whether there'll be a nasty recession and another 30 to 40% fall in equity prices. So until the fog of uncertainty is resolved, my view is better to be safe rather than sorry. This is not the time to be in risky assets.
To avoid risky assets, would you say avoid gold or go with a bit of gold too?
Well, commodities are going to collapse if there is a recession, like other risky assets. Gold is a hedge against tail risk, either of high inflation. I don't worry about high inflation because the slack in the goods, the labor market and housing is going to get bigger and be more deflationary risk rather inflationary risk. Look at US Treasury now close to 10-year Treasury at 2%. But gold is also a hedge against another financial meltdown and a global financial crisis where your deposits are not safe, and even the governments that is not safe anymore. So if you get to that point of paranoia, it's time to buy canned food, guns, ammunition, gold bars, and run to your log cabin in the mountains. That's the mentality that leads to gold to be at 1800 or above. So gold, because of that, can go higher.
You're not there yet, though. You're with US dollar cash. What about other forms of cash like euros, sterling, Swiss francs? Are they good places to put your money now?
I think that if we're going to have another significant systemic problem in terms of double dip risk, risk aversion, equity market correction, paradoxically, people go to the least ugly in a beauty contest, or to the tallest midget, or to the least dirty shirt in a dirty laundry bag, and US Treasury and dollar are the least dirty shirt around. And we've seen it, Treasury yields went down, and in times of global risk aversion, people dump yen and euro and go to the dollar. They also go to the Swiss franc, they also go maybe to the Japanese yen, but the euro, given the fundamental problems of the Eurozone, where there is a risk of serial defaults or serial debt restructuring and eventually of a breakup of the monetary union, I think over time, the euro is going to weaken.
Over time, do you think there's a risk it actually does break up, though?
Not the next 2 years, but I would say that first you're going to have orderly restructuring of debts in countries that are near insolvent. What has happened in Greece is not going to be unique and exceptional as they claim. That's going to happen also in Ireland and Portugal. And if Italy and Spain lose market access, after the ECB stopped doing the bridge loans and after the FSF ran out of money at the end of the year, then if there is not a tripling of the FSF, even Spain and Italy could have, if they lose market access, a debt restructuring. And down the line, some of the weaker members of the Eurozone, Greece and or Portugal, could decide that the benefits of staying in a union are not as high as the cost, and they may decide to exit. That's over a 5-year horizon is a third probability that some member states are going to leave the Eurozone.